Good afternoon. Welcome back to Hurdle Rate. In this video, we're going to build a DCF model from scratch for LVMH, the French luxury conglomerate. As we can see on the chart here, the company very much had a pandemic boom, reaching a high of about 940 odd euros per share, and that has recently corrected back to a low of 430, of which it's now trading at about 560 euros per share. So let's dive into the financials and see what if we can find an intrinsic value for this company. So open up your spreadsheet, and to get the financial statements, this company is listed in Paris. So what you can do is type in LVMH annual report into Google, and you'll get this one, 2025 full year results. Select that one and go 2025 financial document. Once you're on there, come to page 4, and we're going to see the breakdown of the revenues, and that's where we're going to start. So now come over onto your spreadsheet. As always, we remove our grid lines, and we're going to freeze the panes up to column B. Make your A column a bit smaller, your B column a bit larger, and in the cell A1, type MC, which is the ticker for LVMH. Select this one, LVMH, Moet Hennessy, Louis Vuitton. So fill this into go. Ticker go equals A1 dot the current price equals A1 dot price. Date today is the 24th of February 2026. The first section we're going to do are our assumptions. If this is your first time joining, I will explain as we go on for each section. So we're going to build out a full DCF. We start with our assumptions, which is a breakdown of the revenue, the EBIT, the weighted average cost of capital, and the terminal growth value. And that will allow us to simulate different scenarios based on a bull, base, and bear case scenario. But instead of me explaining it all now, let's just go straight into it, and I'll explain as we go along, and I'll try and be as clear as possible. So the revenue segments, we're going to divide the company's revenue into what we can see here. Let me zoom in on this. So wines and spirits, fashion and leather goods, perfumes and cosmetics, watches and jewelry, selective retail, and other activities and elimination. So wines and spirits, fashion, and leather. For those of you that aren't overly familiar with the company, it's not just Louis Vuitton. It's got about 75 brands within it. Louis Vuitton, Moet Hennessy. You've got Sephora, the perfume company, Fendi. There's There's many more. I think it's 75 in total. We just call this other. Save space. In your switches, leave a 2. This will leave a 2 in each of them, in each of the cells, because this will be our base case scenario. We're doing a free cash flow to the firm model, therefore we're going to use the EBIT, not the net income. And obviously we'll be using a weighted average cost of capital too. Okay, we can leave these ones blank for now, and they'll get populated as we continue. The first section of the second section of the DCF is the income statement. And this is where we look at it's the revenue build. And this is where we look at the breakdown of the revenue. And we want to break it down, see what's growing, what's not growing, and then try and forecast each of these out over the next 5 years. Go up to 26, 27, 28, 29, 30. Okay. Yeah. Initially, we're going to have to do a lot of formatting, but once that's done, we can pretty much just copy and paste, and then we just adjust based on the inputs from here. So 2023, for wines and spirits, the revenue was 6 billion. Remember, this is in euros. Was 6.6 billion euros. $5,862 in 2024, 5,358 in 2025. And this is a generic trend within the the alcohol beverage sector, because people aren't drinking as much as they used to be. Particularly, they say the Gen Z and below aren't drinking in the same way as their predecessors, which is probably good, but problematic for companies that sell alcohol. If we put the average as let's say maybe it does go back to a bit of growth. Let's go with 0.5%, and we'll say this comes back to 1.5% growth equals G10. We'll put the base as being 95% of this 1.5% and 105% for the bull case. So to work out for these three cells, we just go equals, we take the previous cell, open brackets, the previous cell again, subtract the final cell, close brackets, divided by, you take the final year, subtract by the previous year, and because we're going to copy and paste this, we need to lock in a few components of this formula. The first one being this cell, this final cell. So we put a $sign in front of the column, but we want the row to be dynamic. This one will always be the same, so we lock in both. And this one will just the row that will be the same. So we lock that one in. And we just pull that along. You want this to be percentage to 2 decimal places. Now, to work, oh, sorry, I need to put bare base full here. We're going to do equals the base multiplied by what we're forecasting the ball to be. We're saying that this will be, so the bear case will be 95% of this 1.5. And lock this in, E10, for me it is in cell E10. And just pull that along. So if things don't work out, we think the growth will be 0.48% next year instead of 0.5. Maybe we're being a bit generous and we should say it's 0.25%. Then we do multiplied by I10, but we need to lock it in. Pull that along. Now, to be able to flick between these different scenarios, we use a function called offset. And for that, you go equals offset, select the cell that we're in, which is F27 for me. Then we select the switch, which is going to be C10, which is this one. And then comma 0. Just do your formatting. Apologies again, I'm on the browser version of Excel because I can't log into my desktop, so the shortcuts are all different and it just makes everything a bit slower. Apologies. So to work out, we're going to calculate, we're going to forecast these revenues now, these future revenues. You just go equal, take your previous year, multiply by 1 plus your growth rate. There we have it. Now, let's say we're on the base case at the moment, we want to go bearish. Remember this number in 2030, 5596, the 5584. We go bullish, 5608. And we can flick between all of these different revenue segments. We can adjust them. We might say, actually, you know what, we want to go bullish on wines and spirits, but for watches and jewelry, we'll be bearish. And we can put this on 1, we can put this one on 2, so we can forecast a different total revenue. And that will be connected to the whole model, so we can simulate different economic scenarios to give us an idea of what the share price could be based on those outcomes. Fashion and leather goods. Okay, so this is the largest revenue segment. 42,169, 4160, 41060, sorry. 3770. That's quite a downturn, but this one, let's say, I mean, it's for a company like LVMH, which is probably fairly cyclical because of the fact that it encompasses, its clientele is also the aspirational rich, so who are subject to economic headwinds, unlike a company such as, say, what was it called? Say Hermes, which is just ultra rich, who, irrespective of whether there's a recession or not, they can afford one of their handbags. Whereas LVMH doesn't necessarily have that same clientele. If there is an economic downturn, spending is reduced with the company. So yeah, that's why I think we're seeing these fluctuations for LVMH, but not really for Hermes, which is, I think, at a near an all-time high moment. But let's forecast 1% for next which, I mean, it's not great considering they did. I know this was the post-pandemic boom, 42 billion 2023, and we're forecasting that in 2029 and 2030, it's not going to be too far off what it was 7 years before. Uh, Maybe let's go 1.5%. Fashion and leather goods. Well, cosmetics. So 8271, 8418, 8174. For this one, I actually think it will do quite well because perfumes are tend to be fairly inelastic. When we copy and paste, make sure to adjust all of these formulas so that they correspond to the correct cell. Yeah, I think perfume and cosmetics has the potential to be the real growth part of the company. And essentially, this goes up to 10 actually. Be a bit generous. And jewelry and 902 574 6 1. We'll say 3% for the watches. For alcohol, let's go 90% and 10%. I think there is a wider swing there, and that it could go really well or really bad. Six, 18, 3, 4, 8. So this part of the business is actually growing. Let's leave it at 1% and maybe let's say go to, and we'll do 3%. Let's just see what the selective retailing is. Okay, so this is things like Sephora. Let's give an outlook. So what would it say the outlook for Sephora is? Okay, let's go back. Yeah. So, okay. Doesn't really give a percentage outlook, so we sort of have to go with what we think. The last segment now. 50. It's a very, I mean, it's small in comparison to the others. It's quite insignificant, so we don't have to focus too much on it, and we'll just leave it at about that. Yeah, at level. We'll say we'll just keep it correctly formatted, but this one we don't really have to. Oh, yeah, looks good. We go into the income statement. We need to go onto the consolidated financial statements. So that will be page 6. Sorry, I forgot to sum up the what we need to do here is we need to get a total for the revenue. Sorry, I want the hard border on it. Yep, that's all of them. Pull that along. Now we can go on to the. Here we are. So this is on page 22. Selected retailing, we haven't selected a 14. Okay, yeah, that's fine. So we want revenue, what we have just counted here, add along. The next one is the EBIT. We want to know what that is as a percentage of revenue. Following the EBIT, taxes. They are as a percentage of EBIT. Okay, so EBIT is your earnings before interest and tax, and that's your operating profit, your operating income. 22560, 19571, 17755. It's not good when you're seeing, well, you're seeing the revenue go down, you're seeing the EBIT go down. But let's see how the margin is. That's getting worse as well. This one is just a placeholder, so it really doesn't matter what we put in. So we're going to do a proper EBIT build out later on, where we can actually simulate between the bear and bull case scenarios. Income taxes, so 5673, 5157, 5476. Okay, so that's the income statement done. The next step are the cash flow items. These are your depreciation and amortization. Let's find this is the balance sheet. Here we are, the consolidated cash flow statement. So depreciation and amortization. Then we have operating investments are the capex, and then you have change in net working capital. So we're going to add these two into for depreciation and amortization. Equals 4146 plus 3031 equals 4658 plus 3228 4858 plus 3143. your total revenue and multiply it by the percentage of revenue. Go capex. So 7478, 5531, 4567. Eight. If you want, you can work out what the depreciation and amortization is relative to capex. This last one is the change in net working capital. This one is nice because it actually tells us what it is here rather than having to do the long addition calculation. Oh, negative 195, 6. There we go. Now this next section is the DCF. And again, we start with total revenue and we put this, I think for me it is C60. Yeah. Pull that along. Again, we want the growth. One of these down. We'll put this going to, let's say, 24%. Actually, 70. In a bull case scenario, we see it coming back closer to that 2023 level, this margin. So then, yeah, you just take your revenue, multiply it by the margin, Then you, yeah, that's it. Pull this to 2025. Your EBIT divided by this. Okay. So now when we simulate between the different EBIT, we will it will adjust the taxes accordingly depending on the tax rate. Because now we have that. Here, right? Then you take, we're going to calculate the earnings before interest but after tax. To do this, you just take your EBIT and you subtract your tax. Then we bring back our DNA, capex, and the change in net working capital. Let's put these equal to what we found out from up here. Now we are in a position to calculate the unlevered free cash flow. And to do that, you take your EBIT, you add back in depreciation and amortization because it's a non-cash expense. Then you subtract your capex, then you subtract your change in net working capital. There you have it. That's your unlevered free cash flow. The next step is we want to discount these future cash flows to what they're worth today. And that's called the present value of unlevered free cash flow. To do this, we need to build a weighted average cost of capital, WACC. So come on to another sheet. Let's go back up to our, remember what the financial statement pages were. It was, we'll have to come back to it. We need to remember this, the number of shares, the balance sheet. Okay, we need to know this. 23. But let's go back to the top where our revenues are, because it gave us a breakdown. So this is what we're going to want to look at. The geography of where LVMH generates its revenues. So, okay, so take this, make it be a bit smaller, a bit larger, sorry. MC again, data, data types, stocks. So the weighted average cost of capital, the WACC, is your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. for that, we need the following information. We need the market cap, which quite easy. Equals A1 dot, no, divided by 1 million though, so it's formats correctly. No. There we go. Then we want percentage of equity, cost of equity. And the cost of equity consists of the risk-free rate, the beta, and the equity risk premium. We'll build all of this in one go, but we'll just itemize the rest of what we need. Debt, we need percentage of debt, cost of debt, and tax rate. Then total, then that there we can get our WACC. Okay, so the debt, let's back onto the balance sheet. Page 32. We want this down here. Short-term borrowings plus long-term borrowings, which is $7,925 plus 1241. So our total is C5 plus E12. The percentage of debt is going to be about 5 or 6-ish. Then the cost of debt takes wherever the interest payment is, the cost of net financial debt, 348. Okay, 348 divided by debt. The interest expense is about 1.71%. The tax rate is, you can find that, 4. Okay, the group's effective tax rate was 32.8%. 32.8. Okay, back to the breakdown. So we have most of what we need. It's just the risk-free rate now. So that cost of equity. The risk-free rate for France is 3.3019%. That we get it from the major 10-year bonds. As you know, when we do a US company, we use the US 10-year. Let's use the same for France, which is 3.3019%. 0.19%. The beta, we need to work out where we think how we break down LVMH into which industry. Wait. So let's pull up our beta spreadsheet. So the first one we're going to do, the wines and spirits, is obviously going to be beverage alcoholic. We might say some of it's apparel. There are jewelry. We might say this one retail special lines. Okay, let's go beverage alcoholic, apparel, and we'll decide as we go along. The good. Was there a cosmetic? To a certain extent, some of it is it is retail. It's deciding which retail to select though. We'll go retail general. So for alcohol, the unlevered beta is 0.7, sorry, no, 0.52, 0.69, 0.69 and 0.67. And retail general is 0.90. Now for revenues, this is easy. We can just go wines and spirits. That's the only alcohol segment there. Apparel, we will say fashion and leather goods. Plus this watches and jewelry. Then retail general, we can put it as just whichever other remainders. Perfume and cosmetics plus selective retailing. Other. So the EV to sales. Again, all of these spreadsheets are on Professor Damodaran's website at NYU. Just type in Damodaran into Google. So DAMO DAMODARAN into Google. You'll go into his website and you can find all of his spreadsheets there. The ones you need are the global beta spreadsheet. So beta global, you'll see that there. And this one is the price to sales global. And what we want from this one, so apparel 2.31, 3.32. So 2.31, 3.32. Retail general. Wrong spreadsheet. What was retail general? Go 1.93. And to work out the value of each of these revenue segments, you just take your revenues and multiply it by EV to sales. Just sum them up. And to work out the weight, you take the value and divide it by the total. In this case, it's F29. Why isn't that? Now to get the weight, you take the unlevered beta and you multiply by the weight. Then just sum. There we have it. So the beta we're going to say is 0.72. Now we're almost there. We just got to do the equity risk premium. And this is where the breakdown of the revenues comes in handy, because we're going to go look at the region, the revenues, the ERP for that region, the weight of each country, and then the weighted ERP. Your region, so we have France, Europe, excluding France, okay, so we take this, multiply it by 0.08, okay. Now that is our breakdown, let's go through the ERP. So come on to this spreadsheet, your country premiums. Again, it's on Professor Damodaran's website. For France, the ERP is, where is it? Go 5.01, right? 5.01%. Europe excluding France. We'll just use this one, 5.27%. Asia excluding Japan. Thing we can do here is, if Japan is 5.14%, delete this. So Asia would be 5.8%. 5.8% without Japan. Japan would be 5.14. The US is 4.46. And other, what we can, let's use this one, the Africa and Middle East, 8.5%. The weight is you just take your revenues and divide it by 13. Means your weighted ERP is going to 0.6239. Okay, so this means so the cost of equity is going to equal your risk-free rate plus your beta multiplied by your equity risk premium. Let's do that. Plus your beta multiplied by your equity risk premium. Now we can calculate the WACC. We're going to use this formula here, which equals your open brackets separated in both the equity and the debt. So percentage of equity multiplied by your cost of equity. Close brackets, open brackets, sorry, plus open brackets, percentage of debt multiplied by your cost of debt multiplied by 1 minus tax rate. Go 7%. And in this one, you get over, go. And a bullish WACC is going to be you subtract 0.5%. And the bearish is you add 0.5%. We're going to use a 2.5% for the terminal growth value because Europe is a bit less. The growth is significantly slower than the US and certainly over the long term. WACC equal Q's. This is like the offset function, but we're using it for the WACC. You just select all of these in the correct order, as you see on here. But it's place it. Good. Have it. I'm back down to, yeah. And above 2026, type in 0.5, then 0.5 plus 1 in 2027, pull that along. We'll see why we're going to do that now. We're going to calculate the present value of the unlevered free cash flow that we calculated. So we take our unlevered free cash flow and we divide it by 1 plus the WACC, close bracket, to the power of the year that we're in. And we're using 0.5, 1.5, 2.5, etc. because we're saying that LVMH generates its revenues throughout the year, not just at the end of the year. So we're using the midpoint as to where we're going to discount back from. So yeah, we have that. Pull that along. But you've got to lock in your WACC. Then pull it along. There we have it. Now we want the terminal value. And this, you take your final year of unlevered free cash flow, multiply by 1 plus your terminal growth value, which is 2.5%. Yeah? Close brackets, divided by your WACC minus your terminal. Then we want the present value, your terminal value, which is, take your terminal value divided by 1 plus, again, your WACC, close the brackets, to the power of that final year, 4.5. Okay. Let's move on to the enterprise value. This is simply the sum of your present value of the terminal value and your present value of the cash flows. And we want to add cash, subtract debt. And we know what our debt is because we calculated it for the WACC. Equal. There we go. And then the cash, we have to come to our balance sheet again. And this is what we want, 8794. From these three figures, we can calculate the equity value. That's your enterprise value plus your cash, subtract your debt. Now, on the income statement, we want these diluted shares outstanding. So we have they have 497 billion shares. So we're going to show what this is in millions. Would be 49. Oh no, sorry, they have 497 million shares. 0.97611. You take your equity value and you divide it by the diluted shares outstanding. That gives us an implied share price of 800 and of 881 euros per share, which would be a significant upside from where we are now. Okay, so let's see if we go fully bearish, what would be the... It would be about 700. And full bullish, a bit higher. Would be more than 1100 euros. Come back to... Okay, so on a base case, there does seem to be a bit of upside. Maybe let's not be so generous with the EBIT. Okay, so it's one to monitor, it's one to look at. The current price is 565. This would suggest, if these figures are accurate, that it could be nearly 870 euros per share. But again, this is not financial advice. Do your own research, plug your own numbers in, and then see what you get from there. But yeah, thank you for watching. Please do subscribe, and I'll see you on the next video. Thank you. Bye.